Good afternoon, everyone. Can you hear me? All right, great, thanks. My blood is already thinning from being in Florida for just a year, but the tax situation's great. So good afternoon, everyone. My name is Ed Swenson. I'm the co-founder and I'm the Chief Operating Officer of Dynasty Financial Partners. Dynasty is a platform service provider to the independent wealth management space. It's a company that we launched in December of 2010 with the purpose of providing technology and professional services to the breakaway advisor and independent wealth management movement. We've also expanded the company to now address enterprises in our space, those large banks and brokerage houses that want to have more of a presence in the independent wealth management space. But before we begin today, I just want to thank our host, Tony Sirianni, and the entire team at Advisor Hub for putting on such a wonderful event. It seems like every year that I come, this event grows exponentially, and so no doubt it's a testament to Tony and the team for all the hard work that they've done and all the great content and the sponsors that are here today. So thank you again, Tony. No doubt this is the last year that we'll be able to fit into this wonderful space. The title of this conference is 1 Billion and Beyond, and the title for my talk is How to Create a Thriving Practice. 12 years ago, a thriving practice would be defined as an RIA that had between 250 million and 500 million in assets under management. This was the core segment of the market that we focused on when we launched Dynasty. All of our sales effort, all of our product and services were focused on what we called the corner office advisors. That represented, 10 years ago, the top 2% of the marketplace. But fast forward to today, because of the extraordinary growth of the independent channel, and thanks to many of you, the top 2% of the marketplace is now closer to $1 billion in assets under management. And that threshold is climbing every year. Some of this tremendous growth in the RIA space over the last decade comes from market share growth at the expense of other wealth management channels, the wirehouses, other broker-dealers, IBDs, and regional players. According to Cerulli, the RIA channel remains the fastest growing channel in the wealth space. Growth of the RIA space over the last decade has been led by M&A and consolidators and aggregators and larger wealth teams making the move to the independent space. Whatever the reason, the average advisor today in the Dynasty network has over 1.2 billion in assets under management. And so I'd like to start off my talk by saying I don't think the goal anymore should be to get to $1 billion. I think 5 billion is the new 1 billion. And I think in 5 years when we're here, 10 billion will be the new 5 billion. And so in this industry with massive consolidation, with access to capital and professional management teams, there is a great window of opportunity for all of us here to build great businesses in this space. So for the remainder of the conference, I'd like to suggest to Tony that we change the title of the conference to 5 billion and beyond. So what I'd like to explore today, though, is what makes a thriving practice? What are some of these key drivers? What are we observing within the Dynasty network with our advisors in our network? What are these now $1.2 billion AUM teams doing that make them unique and allow them to thrive? I see that there are primarily 5 variables that I think lend themselves to thriving practices. The first, increased professionalization of these businesses, and I'll define what that means. Second is a mindset shift from an advisor mentality to a CEO mentality. Third is an intense focus on M&A, which we believe will continue to be a key driver of this space in the coming years. Fourth, scale. Focus on tech enablement and remove internal toil to drive better profitability and better end client experiences. And finally, thriving RIAs maximize the make or buy decisions that are now available in the marketplace for all of our businesses. In the Army Corps of Engineers, there's a quote, "Amateurs talk strategy, professionals talk logistics." Let's apply that quote to our space. The independent wealth space has been dominated by early movers and by entrepreneurs. It is my belief that we are nearing the end of that first cycle. Those charismatic CEOs that dominated the space are giving way to professional operators or teams of operators who have a larger focus on scale, profitability, professionalization, and automation. So, where the model entrepreneur has dominated the last decade, I predict that the next decade will be the decade of the professional manager and the professional operator. The independent wealth space, if you look at this slide, apologies, the space has, because it's been dominated by early entrepreneurs and charismatic leaders, if you look at this slide, you'll notice a few things. First, it pays greatly to focus on professionalization. And those firms that do some things very specifically, very differently. First, firms under $1 billion in assets rely almost 2 times as much on their founders or the principals of the firm to drive revenue compared to larger firms. 84% of respondents in these firms answered yes to the question of whether they rely heavily on their founders for growth. In large firms, only 44% answered yes to the same question. Second, larger firms are 3 times more likely than smaller firms to use metrics and KPIs, key performance indicators, to manage their businesses. When asked if your firm uses key metrics and KPIs effectively in managing the business, 16% of smaller firms said yes, and 45% of larger firms, those thriving practices. So the value proposition in these larger firms has been clearly articulated beyond the founder so that revenue streams and business development can be more diversified into the fabric of the firm and the engine of revenue. And it is clearly defined more objectively in larger firms through use of KPIs. This professionalization is having a profound impact on firms' profitability and on their enterprise values. Operating margins at $1 billion plus firms, operating margins are almost 20% higher than those firms that are under $1 billion in assets. Here are some other important KPIs on this slide. Assets under management per client in larger firms are on the whole 46% higher than smaller firms. AUM per advisor in larger firms are 51% higher than the smaller peers. And revenue per advisor in these larger firms is 43% higher than their smaller peers. All of this while the number of clients that the advisor actually manages remain the same. The key point here is to focus on building out a professional organization away from just the founder or the principal. This requires focus on empowering the management team and leaders below the level of CEO and below the principals of the firm, and to run the firm with leadership decisions being made with clearly articulated KPIs that drive decision-making and propel growth. Number 2, a mindset shift from an advisor mentality to CEO. Thriving practices are led by CEOs that have made the shift from advisor mentality to a CEO mentality. And these are very different roles. This is something that Dynasty is focusing on a lot and spending a lot of time and resources on with our network of advisors. Mark Tiberghien, the longtime leader of Pershing Advisory Services, used to use the analogy that the RIA space was evolving from practices to businesses to enterprises. And this is what we are seeing in the space right now. Local firms are turning into regional firms, and regional firms are turning into national firms. A team that has $250 million in assets under management that charges about 1% on fees has an average practice worth somewhere in the range of $3 to $4 million. A $1 billion AUM firm that charges the same on fees is worth somewhere around $15 to $20 million. These valuations are obviously dependent on growth rates and the ROA on the book of assets, but they are approximate numbers. The point is that to get to a $20 million valuation in enterprise value, there needs to be a very different mindset from the CEO. This is a little small, but I'll read it to you, and if anyone would like the slides after, let me know. So here are just a few important mindset shifts that thriving advisors make as they make the transition to CEO. First, end clients are the lifeblood of our industry, and an advisor mindset is to prioritize the client at all costs and above all else. And this is right and it is honorable. But at some point, to build a truly thriving practice, this mindset shift has to change to a CEO mindset. That mindset is first accountable to the entire organization. Second, an advisor receives almost instantaneous feedback based on new clients and assets under management into and out of their practice. A CEO's feedback loop is much longer and should revolve around different metrics and considerations which include organizational health, strategic goals, talent management, and capital structure. So where an advisor's feedback loop is immediate, a CEO's feedback loop comes in much longer cycles, 18 to 24 months, and is rarely clearly understood at the time. Third, an advisor always has an urgent mindset. Urgency, again, is the lifeblood of any growing practice, but thriving practices allow the CEO or the CEO demands to work only on those things that are important to the organization, not urgent, but important. The CEO creates a structure around him or herself to take as much of the day-to-day tactical out of their hands as possible, and this is critical for creating a new mindset within the organization. As I said, this is an area where we are spending a lot of time. Last year, we took over 25 of our network CEOs for 3 full days to MIT's business school, an especially curated agenda with some fantastic professors, and we talked about what mindset shifts have to occur for advisors to make the transition to a CEO and a thriving practice. If you believe, as we do, that the next stop from $1 billion in assets is $5 billion in assets, and then from $5 billion in assets to $10 billion in assets, then the CEO professional development and mindset change is absolutely critical to making this happen. Number 3, M&A continues to be a key driver of thriving practices. M&A is probably one of the most talked about topics in our space, but we believe that's for very good reason. With more capital than ever coming into this space and with more professional management teams and operators, this fragmented RIA industry will continue to consolidate, and the firms that do M&A well will win disproportionately to those that do not. You do not need to be a private equity firm to take advantage of this opportunity. The independent RIA can take advantage of this trend very easily. Once a firm goes independent, they then have the opportunity to discuss that option of going independent with other peers that were back at the bank or captive channels where they came from. Those in the RIA space already can play the role of consolidator of those players in their local markets, and it's an enormous economic opportunity. Why is M&A so attractive? There are 6 reasons. First, the RIA market itself remains very fragmented. There are 26,000 RIAs in this country. Half of those, about 13,000, have less than 100 million in assets under management. They're subscale. Second, we have a continuing aging demographics issue in the RIA space, with few good succession plans in many of the practices that are out in the RIA space. Third, purely from a business perspective, independent RIAs as a business have strong free cash flows and recurring revenue, which make them inherently valuable and portable from a business perspective. Fourth, and I put an asterisk on this one, cheap debt. Cheap debt is no longer as cheap, but it's still a really good deal if you want to do consolidating in the space. Fifth would be multiple expansion. In our space, size and scale matter. If one can buy an RIA at 6 times earnings and later sell it at 8 times earnings, there is an embedded growth in the enterprise value just from reaching economies of scale, and those advantages alone add value to the enterprise. And then sixth, I put another asterisk on this one, strong stock market performance. Not recently, but 70% of the time, the stock market goes up, and so long-term, the underlying intrinsic asset that these RIAs have is growing, and that AUM increases enterprise value to the owner. What we see in thriving firms is that M&A becomes, though, a full-time job. It is not something a principal can do just on the side as they're prospecting for new clients. It's a full-time job, and the resources must be dedicated to those thriving practices to do it right. Even in a relatively bad market this year, M&A, RIA M&A, continues to track very well. This is due to demographics, as we talked about, and smaller subscale teams wanting to get scale and more profitability by joining your larger teams. We are also seeing teams with $1 billion plus partnering up to better take advantage of combined multiple expansion, scale, and diversification of their revenues and of their risk. Our thesis is that valuations in the space will remain high. Perhaps not as high as Q4 of last year, but we are not seeing a significant slowdown in the desire to own these attractive assets. Number 4, for thriving practices, scale your operations, tech enable what you can, and reduce toil. We are probably the last industry to see massive disruption to our model from technology. Retail, travel, print media, entertainment, manufacturing, cable, even oil and gas have all seen tremendous change in the past 2 decades. But because we are in a highly regulated industry and we have strong gatekeepers, we generally do not see widespread adoption of disruptive technologies, but it is coming. And I do not mean robos or do-it-yourselfers. I think the robo movement is a failed concept and is generally seen at the end of a long bull market cycle. Advisors will be as valuable as ever going forward, especially more now in the current difficult market environment. Flexibility, speed to market, enhanced capabilities, they all now live in the cloud. Better, faster, cheaper. It allows for the proliferation of best of breed, better cybersecurity posture, and a much better advisor and client end capabilities. In many ways, wealth is last to this party, but it will be disrupted. Think about capabilities of Amazon, Uber, Airbnb, and others that have changed our lives, but we are still fundamentally having a hard time getting a good enough client portal out to our end clients. And this is all going to change. Those firms that embrace technology are thriving and they're growing faster. It must be a core focus of every thriving practice. Data indicates that firms are embracing technology, but I would argue not fast enough. Those firms that are embracers of technology, meaning that it is core to their business strategy, are growing faster than those that are not. The tech-enabled firms are seeing organic growth rates that are 2% higher on an annualized basis, as well as 4% higher on an annualized basis for client organic growth over a three-year period. Firms that invest and understand how to use technology thrive. Of those firms with $1 billion or more in assets under management, 56% of those said that technology was one of their key strategic initiatives. Firms with less than $1 billion in assets, on average, listed it as a top priority only 43% of the time. Use technology instead of people. We call this reducing toil inside the business and to leverage automation to drive efficiencies and profitability. Use technology to create repeatable processes, and use technology to lower your key person risk inside your business and to give yourself, as the owner and manager, more transparency into those key KPI drivers that value your business. Use technology to create better end client experiences. Better client experiences will lead to better top-line growth, more referrals, and better end client retention rates. Point number 5, maximize the buy advantages that are available to you in the marketplace. This is a little confusing. I'm going to walk everyone through it, hopefully. This is a matrix which I originally got from the Boston Consulting Group. I've tweaked it to be more relevant to the RIA space. But what it does is it helps a CEO or owner think through the make internally or buy decision when it comes to certain professional services employed within your firm. Every thriving company in the world outsources. The key issue for thriving RIA practices is what do you outsource and what do you keep in-house? I would make the argument you outsource everything that is not core to your company's unique value proposition in the marketplace. If it can be commoditized, outsource it. Insourcing too much can be people intensive, requires more of your management and time, it's draining, and it's less cost effective than outsourcing to a professional services firm. Think of this graph as your strategic value guide as you figure out what is core to your company's value proposition. On the y-axis, you have the relative cost of outsourcing. Is it less expensive to you to outsource than to insource? Think about people costs and the cost and time to manage these people in your model. A good example of this might be compliance, where hiring a full-time CCO for almost any RIA is inordinately expensive versus outsourcing elements of this to a firm that provides you this advice. On the x-axis, you have strategic value to your company. If compliance is not strategically valuable to you, then it would be in the low category. And because you can get it relatively inexpensively, this would be a clear example of something that's quite better to outsource. A final example of this, another example might be third-party investment management. Analysts versus insourcing analysts versus outsourcing to someone else. Clearly, if you're covering both third-party long-only and alternatives, that'd be quite a lot of expertise that you have to have in-house. That is very expensive, and these qualified people then have to be managed. Where that might not be the case is if third-party money management or alternatives are essential to your business. And if that's your key differentiator, then it might make sense to insource all of that and to incur the costs. A final example would be M&A. To hire or insource someone in the RIA industry to run pro formas, understand structuring in the space, understand current valuations, and help you negotiate deals, prohibitively expensive for almost all of our firms. Thriving firms leverage an outside team to do all of this. Dynasty, for example, has 5 M&A professionals, and our network of teams leverage those M&A capabilities to do advisory deals. This gives them a competitive advantage in the space versus their peers who do not have those resources. It gives them more opportunities, more shots on goal, and faster outcomes, and more insights into what the valuation and structural alternatives might look like in the space. All of this while freeing up the CEO to focus more on what they do best to drive value. I would urge everyone to think through the build in-house versus the outsource model. Thriving practices do this very well and embrace outsourcing, understanding the true costs of resources, time, expertise, and key person risk that go into this decision. Unlike 12 years ago, there are many good options now in the market to support all of our firms. It rarely makes economic or strategic sense to build up some of these non-core capabilities in-house. So in conclusion, thriving practices. About thriving practices. $5 billion is the new $1 billion. As the Army Corps of Engineers says, amateurs talk strategy, professionals talk logistics. Thriving practices focus on at least these 5 things. Professionalization of their practices. Do this through use of KPIs and broadening your leadership team and the revenue gathering forces from just the principal and a few leaders in the firm. Create a strong foundation for growth. 2, the mindset shift from advisor to CEO. Focus on what's important, not what's urgent. Firm health and long-term, not immediate goals. 3, operators will define the next 10 years in our market. Focus on M&A to drive inorganic growth. The window is open and valuations and opportunities are there. M&A should be a full-time job. Scale and tech enable. Use technology to reduce toil and your key person risk. Use technology for better client outcomes and more insights into the core KPI drivers of your business. And finally, the in-house versus outsourced decision now available in the marketplace. Be thoughtful to what is really core to your business and outsource everything else that is not. Finally, I want to introduce 4 thriving Dynasty Network firms that are here with us today. Each one of these advisors runs a thriving practice, and all are winning awards this year from Advisor Hub for their leadership and success and growth in the space. If you get a chance, please talk to them during the conference. Congratulations to Mike Durso, Craig Finley, Miguel Sosa, and Lisa Van Wallingham. And thank you to everyone else. Good luck in building thriving practices. I look forward to catching up with you during the rest of the conference. And if anyone wants any of these slides, just please reach out to me. I'm happy to share them. Thank you again.